Rock and roll. We got another Build Your Legacy masterclass with the one and only Hunter Thompson, author of Raising Capital, a good friend of Andy and I's. So really pumped up to talk about Raise Masters, Raise Fest, Raising Capital, and of course, ASIM Capital, your company. We're definitely going to dive into some of your business models, what you're investing in, and definitely talk some shop about capital raising. So welcome, Hunter. How the heck are you?
It's an honor to be on. Real exciting. There's a lot of crazy stuff going on in the market right now, and it's a really important time to have this conversation about raising capital. Things are changing, and generational wealth is going to be created in the next 3 years. I mean, it's just going to be, it is the case, but you got to be able to come up with the money to get it done. And so that's what I'm here to help you with.
Rock and roll. Andy, you got any introductory statements before we get started here?
No, let's get on. I love how, we don't have, Hunter always starts with the topic, like, let's dig into it, right? The world's falling. How do we fix it? So more time with him. Usually, Hunter, you have like music and dance. So you might have to be kind of self-motivated here today. Yeah, no, let's just dig into it, brother Ruben. Let's hit him.
All right, let's start with the obvious, man. The AENC business model. Can you talk about what that means and just give a brief description of that as a baseline to start with for today, Hunter?
Yeah, sure. So I guess, a lot of us, when we get into this world, we kind of read Rich Dad, Poor Dad. Then we start looking around. We maybe listen to some podcasts. Maybe you find my book. Maybe you find like Rob Beardsley's book. Maybe you find Joe Fairless's book, and you kind of become evangelized into the world of real estate. And if you're a good person, you're like, oh my gosh, I got to share this with my friends and family. And you go to share it with them, and you're shocked that nobody's interested, and people think you're a scammer, and they just have no interest. Like, you're like, hey, listen, this is going to produce 8% cash on cash returns, and it's predictable and it's recession resistant. And you're like, don't you want to invest in this? And they're like, why the heck would I ever invest in a multifamily apartment? That probably is illegal, first of all. Second of all, I've got my S&P 500 stocks that I don't own or control or have any due diligence on, and I'm perfectly comfortable with that for some reason that no one understands. It falls on deaf ears. And the reason, it's not their fault. The reason is that you went through this very self-directed path of undoing a lot of propaganda that you were learned since you were like 5, that money and everything about it is basically lies. And then you've uncovered this whole different world, but you yourself uncovered it. And so when you go to your friends and family, you're trying to streamline all this research, all this due diligence, all the podcasts you listen to into a 20-minute pitch, and it's almost never going to work. And the reason I know that is that this is exactly what happened with me. And especially when the market was correcting in 2008 and 9 and 10, I found a mobile home park fund that was going to buy assets that were trading at 10% cap rates, based on trailing financials. And you could borrow money at around 4% back then. And I went to go raise money for this deal and didn't raise a dollar. And so basically I was embarrassed. And I know a lot of you read my book, and so you probably know that story. But I basically spent the last 10 or 13 years of my career building something that ensured that that never happened again. Building something that would attract, educate, nurture, and close investors through hyper scalable, not one-to-one, but one-to-many strategies, such as content creation, webinars, podcasts, downloadable reports, Excel underwriting models, virtual summits, in-person event, you name it, I've done it. And so that's how I went from, struggling to raise a dollar to raising $85 million of equity. Again, that's not debt financing. That's not co-GP money. That's not partnership money. That's like me personally. There's a lot of people that have raised a lot of money, but not many that can make the claim that they've raised $85 million from retail investors themselves. So, and again, I don't want to say that there's no one. There are plenty of them, but you all know their names, right? And so because of the success of that, I wrote a book about the topic and kind of gave it away for free. So that's really what the ANC system is all about.
Okay, so attract, educate, nurture, and close. We'll definitely dive into, hopefully we can break those down a little bit and kind of dive into each one of those parts. I referenced you quite a bit on the show, actually, on the Capital Raiser show, one of the first guests ever to come on there. So that was a great deal of fun. So these capital raisers, they reach out to me and they're kind of curious about like what they should raise for and like what markets and what asset classes, and they want some direction and stuff like that. And I reference this particular story that you have in the Raising Capital for Real Estate book, which is when you talk about the cow farm and how a lot of people, even though you may offer a 50% return of investment, if they don't understand the business, they'll never invest regardless of how much return you're putting in there. So I tell them a lot of times, hey, pick something that your investors actually will want, that they can understand, versus like try and put together a business model that could be lucrative, but doesn't necessarily appeal to the masses. Do you have any thoughts on this particular concept that you can
It's
share with
so
us?
crazy that you say that I wrote about that when I wrote my book. I've learned so much more about that particular topic since writing that book. As someone who prides himself on, if you look at the DISC assessment, for example, I'm super high I, super high D, super high I. So I like to influence other people. And so when I'm at my best, I'm kind of uncovering unique things and then sharing it with people that I like. That's kind of like an important piece of my personality. That's why I have my podcast and why it's, been well received, because I'm genuinely curious and also genuinely want to share. So the problem though, is that in the world of investing, sometimes you can try to find this shiny object that no one's ever heard of or no one's ever done. And you find yourself, hey, listen, there's no real competition in this really obscure, nuanced asset class or tertiary market no one's ever been to. You got to take 8 connecting flights to get there. And so for someone like me, early in my career, I wanted to uncover those unique opportunities and share them. Like, wow, no one's figured this out, and yet I'm the one that figured it out, or I'm one of a few people that figured out. Come over here and let's invest in this unique niche. And so I did that for the beginning of my career. Now, I didn't do it to a crazy extreme, but let's just say mobile home parks, for example, that especially 10 years ago took a lot of time and convincing. And I think something I've learned over the last couple of years is that can really materially impact your career if you look at a multi-decade approach. And so recently, for a lot of reasons, which we can get into if you're interested, but we've actually sunsetted doing any deals other than Phoenix multifamily apartments, because there's a lot of reasons, but one of the many reasons is that if you could just raise 20% more equity, think about how that compounds over a 50-year career, especially when you leverage that 2 or 3 to 1. Another thing, though, is that when you go into these tertiary asset classes, in the state of the market and it dries up, you run out of friends really quickly. In multifamily apartments, you've got a lot of friends and they're making a lot of money. And so you've got a lot of buyers and sellers. You've got a lot of participants. You've got a lot of people making millions of dollars. Brokers, debt brokers, property managers, all of them can be replaced and are replaceable because there's infinite other ones. If you go 45 minutes outside of some submarket you never heard of in Kansas, there's like one option. And if they suck, what are you going to do? And so, I learned that lesson the hard way in the mobile home park business. And so we're actually I don't want to do anything unique at all. I want to go into one of the most competitive markets and out operate everyone, and also buy when there's distress in the market, which there is now. So it's crazy that I wrote about that in my book, because even now I feel like I know that now and didn't really know that then.
So when you're out, now I think you've done some fun deals where you did, ATMs, I believe you did at one point, and you did some other kind of projects. How does that kind of new pursuit change how you manage some of those projects that you've currently got? Because I mean, Hunter, honestly, outside of my assistant, I don't think I've seen somebody do more things. Like, you've got the pod, you got the book, you got the social media. I see an email in my inbox every day, and then you're also having to manage the fund, right? So, one, I'd like you to talk a little bit about that and how you're kind of, managing this state of affairs today, because this market, those same investors that were maybe super happy, they might be medium happy. They may be happy with you. They understand you've been communicative, but they're looking at their returns and it's not where it was a few months ago. So maybe talk a little bit about state of affairs.
Totally. So just for full context, since inception up until about 12 months ago, we were a capital allocation firm, and we would partner with operators that were specialized in their respective niches, such as mobile home park, self-storage, office, industrial, debt, ATMs, as you mentioned, and maybe some other non-real estate assets. And so the appearance of kind of being a jack of all trades is not really the case. I was actually a specialist in finding quality operators in these various niches and would defer to their expertise on the oversight and operations and management of those assets. And so that allowed me to provide a very diversified approach to our investor base, but the operators themselves were hyper specialized in one asset class. And so I viewed myself as being specialized as well in the sense of finding great operators. I spent my time flying around the country, conducting due diligence, due diligence process focused on the operators versus the deal, for example, though the deal was included. And then, so for right now, there's deals that we've done with a lot of sponsors. And because of that, there's a big spectrum of what's going on out there. Deals that we did with fixed rate debt in quality markets are performing very well. And there's really no negative correspondence. The ATM machine fund, by the way, that we did and raised quite a bit of money for is doing very well and has performed exactly as projections as of the recording of this. And I don't see a reason why it would change. We also did deals with floating rate debt in very competitive markets. And those sponsors are very well capitalized. But my goodness, if the Fed doesn't reduce rates over the next 2 years, the flood will rise to a level that will take out everyone, but everyone would be distressed. If interest rates stay where they are right now for the next 2 years, any operator that bought a property in 2021 is going to struggle. There's no way around it. Struggle, I mean, potential for capital calls, private equity to come in, or foreclosures. That's just, anyone can run the math on that. In fact, can I real quick? Because I think maybe your listeners might think it's interesting.
Yeah, I was just about to do it. So you do it better than I can.
So
go ahead.
I just did a masterclass on this topic called The Multifamily Meltdown and How to Profit from It. And if you join my Facebook group, I think it's still up. And if you ask around, you'll probably be able to get a link. Private Facebook group, just go to facebook.com, search Raising Capital for Real Estate. There's almost 20,000 people in there. Okay. So I'll just cut to the chase. If you bought a property in a competitive market, anyone that you've heard of people buying in Houston, Tampa, Texas, Florida, those markets. If you bought a property at 3.5% cap rate and a 4% interest rate with floating rate debt, which was standard, if you got a rate cap, which we of course did, but if you got a rate cap at, let's say 6.5%, which is relatively high, even if you increased NOI by 30% over the last 2 years, that would be like you are incredible at operations. You increased rents, you reduced expenses. Your NOI is still not going to cover debt service if you hit your rate cap. And that's if you got a rate cap and the rate cap hasn't expired yet. Meaning that you fully implemented the business plan. You did it. You hit a home run. You're the kind of operator I would want to invest with over and over again. And there's no path to you catching up with interest rates if they stay the same. And that's the unfortunate reality that we find ourselves in. And let me just reiterate, that is if you totally crushed it on the operations side of things. So my view is that I personally don't think the Fed is going to hold interest rates where they currently are for the next 2 years, because the floods would rise to a level that I don't see them rising to personally. But, I've been wrong before. And, again, that's best case scenario, what I just outlined.
Hunter, I was just talking to a bank yesterday, our bank on one of our properties, and he was telling me about an operator who'd increased NOI by about $7-8 million, right? This is a major property, and had to put more money in because of that 30% we're talking about, where now you've got, your loan to value. He crushed it, but he's got to put more money in. So those operators that aren't well capitalized or don't have their own money to be putting in, there's going to be a lot of opportunities for people that are on this call. And if you're, for the audience too, if you were to kind of follow the forward curve and kind of take a tally of most of the Fed, they also believe that they're going to come down. Now, that doesn't mean anything. It's more kind of betting on whether they're right or not, whether more so than what they're telling you they're going to do. But if you were to get on like Chatham Financial or some of those, you could kind of see where the curve hopefully will go down. If it doesn't, we've got a lot of problems. Go ahead, Ruben.
Yeah. So I'm really curious about Phoenix, Arizona. I'm a native Phoenician, born and raised here, lived here 48 years. I've seen some crazy things even when I was a kid. My dad started in single family residences back in the 70s, and he planted a seed with me for real estate in this particular market A lot of big time syndicators, or even probably even bigger than syndicators. They live here, because I notice a lot of the multifamily guys, they live in California or somewhere else. There's not a lot of syndicators that you can invite to your meetup that live in town. But Robert Kiyosaki lives here, Ken McElroy, a couple other syndicators. Rise 48 is here. I think you've done some business with them. Great guys. A lot of people are not bullish on Phoenix right now. So I was hoping that you could explain why you've selected this particular market, because a lot of people that have been making a bunch of money with not the greatest operations are starting to struggle in this market. And I'm telling people that Phoenix in particular, if you have great operations, you can still actually raise rents, even though across the valley, they're actually going down, because a lot of these multifamily properties are not run by great operators, or have not been recently. Tell us about why you like Phoenix.
Yeah, good question. So, I mean, let's talk about just the fundamentals, right? So it's the number one fastest growing city in the United States. It's the number one fastest growing job market in the United States. It's the number one metropolitan area for net migration over the last 3 years consecutively. Property taxes are limited to increase by only 5% per year, and there's no hurricanes, so the insurance costs are predictable as opposed to some of the other competitive markets. Now, those are some pretty incredible figures, but to your point, that doesn't paint the whole picture at all. From my perspective, what we're dealing with in Phoenix is not really about the fundamentals, but is almost entirely about interest rates. So you are seeing some softening in Phoenix with rents. You are seeing some softening, but we're talking about like 1%, 3%. This is basically immaterial compared to the interest rate thing. So you don't see distress in the market typically when rents, go from, let's say, 5 or 8%, or in some cases 22% increases to now only increasing by 1% or 3%. That's not a reason for distress. In the markets that we're in, those are kind of the numbers that we're seeing right now, which is that rental growth, which may have been expected to be 5%, is now 3% or maybe 1%, depending on the operator, depending on the market. Maybe concessions are coming in, but all of that is almost irrelevant, because you can't do anything compared to your interest rate doubling or increasing by 60%. So what's happening now is almost all of the distress is financial distress, not fundamental distress. It isn't that 500,000 people moved to Phoenix and then now moved away from Phoenix. It isn't that the supply-demand imbalance has been solved and the affordable housing crisis in Phoenix is now done. It's that when you buy assets with floating rate debt and the rate cap is hit or is set to expire, there's going to be distressed sellers. And so when people say, isn't there softening happening in the market? I'm like, 100%. That's why my partner, who just got married, is moving from Michigan to Phoenix and now is living there, because we're backing up the truck to buy what we're talking about right now.
Okay,
And
cool.
just for context, I will mention this. He just got married to a second generation Asian girl, so like, who lives in Michigan. So like, when I say we're going all in, like, this means a lot to her and her family, that they're going to move across the country to go buy these discounted assets. So, sometimes money is the way to show how much I care. In this case, it's like, my partner and I are committing our lives to this thesis. And by the way, for good reason, because we just bought an asset that was marketed 12 months ago at a 4.0 cap, and we just bought it for 5.7 cap with a 1.4x DSCR coverage ratio month one. 5-year fixed financing. So without knowing too much more about the deal, the predictability of outcome is just very high. Now you can hear that and say, wow, who wouldn't do that deal? It's like, no one. You can only do deals like that when there's distress. You can only buy deals like that in Phoenix when there's significant distress in the market. And so now's the time to go all in. But it's way easier said than done, because raising capital is way harder. There's fear. There's people saying Phoenix is going to run out of water. And all of that creates this once in a generation opportunity. And we'll capitalize it. And we want you to as well. You know what I mean? We want everyone listening to this to capitalize it in their respective markets.
So I got to ask you, if I could, on that, just as a follow-up. So raising capital for everybody has been difficult right now. I imagine you kind of limited to one market. For you, just personally, I mean, just open up the kimono just a little bit. Tell us that maybe you're not completely of armor. Tell us, like, what have you had to do that's different now to raise capital that may have just kind of flown off the shelves in previous years?
Oh, dude, that's such a good point. And so for those that don't know, I own a company called raisingcapital.com, which is our e-learning info product mastermind part of our business. And so we have ASIM Capital, which is our private equity business, and raisingcapital.com, which is where we teach people how to raise money. And so we're kind of on the front lines. We have over 400 active members that are, many of them have raised tens of millions of dollars. Some of them have never raised a dollar. So we have a very good pulse of like what's working in today's market. Plus we're doing it ourselves. And so if you were to ask me 2 years ago, what we were leaning into from a marketing standpoint, we were talking about, hey, I just raised $9 million in 17 days without doing one phone call. It was like 8 phone calls or something like that. That was like our marketing, right? It's like, how cool is that? Don't you want to have a business like that? But now we got to get way more scrappy. We've got to do those phone calls. And I mean the principles. I mean, we need to make a good impression. We need to make an impression that's going to last. We're getting way more scrappy about reaching out. We're getting way more scrappy about sending text messages, which is something that we didn't really have to do in the past, trying to get that back and forth, trying to get anything to engage. Another thing that we're implementing is email is really, really powerful and hyper scalable, but DMs, let's say LinkedIn or Instagram or Facebook, are way more powerful in terms of the open rate. Think about it. The open rate of a good email list is somewhere like in the 20 to 30% range. The open rate of DMs is way higher, but the response rate is like 100x. Like, when's the last time you got a response from an email? Like, you send out 1,000 emails, you get 1 response. You send out 100 DMs, you get 30 responses. So it's very, very compelling. And so those are the types of things that you have to do now. But my goodness, my confidence in the success of that's proof right there. There's 2 ways that you can prove it, right? One, and probably the most powerful, is just the debt financing. If you can buy fixed rate, 70% LTV, assume that you won't raise rents in the first year and will bring unrenovated units up to the rents of currently renovated units, and you can get to a target IRR of 16%, like, I don't need to know much, but if you're talking about a prime market, that's a market that's in distress. That's the only possible way you can make those numbers pencil. And it's a good time to buy, right? I don't need to know, like, look out for the last 50 years of a respective market. That would be something that I would want to do in all stages of any kind of climate. The other thing, though, is, how difficult is it to raise capital? Because the reason anyone would be selling right now is because they can't raise the money to continue the business plan. And so it's hard to raise money. That means the deals you buy are better. So it's hard to do, but this is when it really, really matters. And I'll put it in perspective. For those of you that have been in the business for a long time, or those of you that have conducted due diligence on operators that have, when you look back and you see those deals that they bought in 2008, 9, 10, don't you feel like, well, that doesn't even count, right? You're like, oh, 48% IRR, but like, dude, you bought it in 2010. Like, that's not really, I'm not going to factor that into how good you are, because it's too good. It doesn't even count. Well, that's like what we're about to go do in 2024. It's about to be the kind of thing when people look at your track record, they go, well, that doesn't count. And meanwhile, they didn't know what you had to do to buy those deals, because you had to scratch and crawl and negotiate with the lenders and talk to the investors. But in 5 years, they're going to be writing it off your track record and saying, it doesn't even count. That was when all that crazy distress was going on. Interest rates were going crazy. And yeah, you got a couple good ones in, but it only counts starting now in 2026. And it's like, okay, we'll say that's fair, but the bank account doesn't care when you bought it.
Good stuff,
awesome.
Hunter.
Great.
So we understand that you're becoming a full-blown operator here, but we want to address the emerging fund managers in the space, right? So I hang out with a lot of fund managers. They're like 1 or 2 people shops. They're like, I used to be the full-blown GP, and now, like, I think that I don't need to do that anymore. It's a lot of work. I'd rather just go raise some capital. They have like 1 or 2 people teams, 1 virtual assistant. They focus on what you mentioned that you were doing over the last kind of decade, which is finding amazing operators and then doing the investor relations and managing their fund. I want to know, like, can you actually raise capital in a fund if you've never done a syndication? I know the answer to this, but I want to hear it from your words. Do you have to have a track record of 16 syndications before you launch your fund? Or, who is actually able to raise capital in a fund?
So I'll be super careful about the language because there's a lot of confusion about this. And part of this is just the common vernacular is confusing. But the first deal I did, and, in short, I never answered any questions about my track record pretty much through my whole career, because what I did was at the beginning, the first $50 million I raised was for very experienced operators. And the way that I did it was I would go to them and say, hey, if I show up on your doorstep with $1 million, will you give me a slightly better preferred return and a more favorable waterfall? Meaning your normal investors are investing 50 grand or 100 grand. You've got a 7% preferred return with a 70-30 split. If I invest $1 million with you, would you give me an 8% preferred return and an 80-20 split? And usually they'd say, well, do you want any voting rights? I'd say, no. They'd say, do you want any control rights? I'd say, no. Are you trying to be a partner with us? I say, no, I'm just going to show up with $1 million. And they would say, okay, we'll give you the more favorable economics. And then what I would do is I would go out and try to find 10 investors that want to invest $100,000 each and say to them, hey, listen, I found a great operator. I flew and saw them. I spent hours, probably 100 hours on due diligence. I ran background checks, criminal checks. I verified the things that they said. I talked to other investor referrals, et cetera, and their CPAs and their lawyers and everything. And what I want to do is I want to pool a group of 10 of you together and invest in their deal. And look at their track record and look at their thesis and look at all the gray hair they have. And all I'm going to do is keep the extra economics that I negotiated by pooling you all together. Now you can go direct, but I'll never talk to you again. And if you invest through me, you're going to get basically the same money because all I'm keeping is really the delta that I negotiated with them. And usually they would say, okay, because I like you, Hunter, and I trust you, and I want to invest with you. And I'm funding to a bank account you control, and I know that you will fund that money directly to the bank account that they control. They're going to do all the deals. They're going to do the operations, and then they're going to initiate a distribution to you and your entity. People call this term a fund of funds. I used to call it a piggyback fund. Another more appropriate term is a special purpose vehicle, an SPV, whose special purpose is just to invest in one deal and then act as a flow-through entity. And at that entity level, not at the deal level, at the entity level, I created an extra waterfall, a 90-10 split. So that basically I'm just keeping 10%, but the investors are getting the same because 80-20 minus 10 is 70-30. Does that make sense? I know we're not looking at a spreadsheet, but theoretically, does that make sense?
Yeah, I follow you.
So that term has become very popular recently for a lot of reasons. And it revolutionized my career, and it can revolutionize yours as well for a million reasons. Number one, all you got to do is raise the money and administer the SPV. Number two, you can participate in any asset class. Number three, you can partner with incredibly talented people with robust backgrounds. You can totally permanently overcome the you don't have a track record objection. It allows you to just do amazing things and probably focus on the one thing you actually want to do, which a lot of people, at least people that listen to me, they want to raise money. They don't want to focus on operations. And so this is a tool that I believe is compliant. Now, there is some debate about this, which we can talk about. Any nuanced securities law discussion is going to be, there's going to be debate about the compliance of it. But I believe it is the most compliant way to do this type of thing. And I have tried everything for context.
Okay, so I've been vetting some operators that I could potentially work with here recently, and I've kind of come to light and thought about some new concepts because a lot of operators over the last 10 years, when they bring in a co-GP or a fund to fund, it's kind of like, yeah, we'll let you raise money for us, go at it. And, when you have the money, come back to us. And then I've come across some other people, they're just like, oh, this is not the right support system for a fund manager. Like you should be helping them with communications, giving them data, giving them infographics, social media posts. Now, what does a successful fund manager, what can they expect or what should they expect to receive from the sponsor that they're raising the money for? Is this additional support something that let's talk about this particular thing because it's not something that people are contemplating right now. Because most of the time they're just like, yeah, I'll go raise for this guy and I'm on my own. But there's actually some companies out there that are helping the fund manager. How important is this? Tell us about this.
So cool, because right now we're like walking on the moon. This conversation is happening right now. I did a presentation in 2018 at the Best Ever Real Estate Conference about this topic, and it was voted the #1 topic of the conference, not because of my speaking skills, I can promise you, but because everyone was interested. And so now because of that, people are starting to uncover the power of this vehicle. And so to your point, now as the market is maturing, fund managers are demanding a little bit of help. And so from my perspective, look, if your goal is to show up on my doorstep with $1 million to help us buy deals, especially these deals that I talked about in Phoenix, I want to do anything I possibly can to make it as seamless as possible. Now, we are constantly having conversations about how best to do that, but we want to find the best service providers that are the cheapest. We want to get you connected with them immediately. We want to provide you the marketing documents. We want to provide you the emails. We want to provide you the talk tracks. We want to help you actually get the money across the finish line. And we want to put you in the best position possible, meaning run a webinar with you where you're the principal, where we have partnered with you on this deal, which is true. And so you get to run the show. We're there to support you. We go through the deck, but again, it's your entity. It's your investment opportunity. It's your private placement memorandum. It's your operating agreement. The investors are funding to you. So it's in your best interest to make us look good. It's in our best interest to make you look good. And it's a great way, especially if you're raising your first $1 million. It's a great way to do it. And like I said, I raised tens of millions of dollars like this. So it's actually pretty infinitely scalable.
So talk about that then, because I think you've got a program. So maybe you dig a little bit deeper because you have a program like for the fund to funds. If we can
Yes.
tee you up for that, I would love to hear
Yes.
this because I think we get a lot of questions about how can you really, help these folks that have the relationships, but they don't understand how to do it. So tell us a little bit about this program that you got.
Okay, cool. Quick story about this. And I'm not going to bore you with this, but there's a good little takeaway here that everyone will be interested to hear. So I have a mastermind, which is not cheap. It's tens of thousands of dollars. And we have hundreds of people that are in it. And so that's like our core product, our core offer. It's called Raise Masters. Maybe many of you have heard of it. It has been an incredible roller coaster and ride. And it's been amazing. I'm very grateful for everyone that's been a part of that. So because that is like a premium high touch offer, there's a big gap between buying a $7 book and like a $30,000 mastermind. And so we wanted to create a product that was like a stepping stone to get to our core product. And so I created something called Fund to Funds Mastery. The goal was to sell it for $4,000. And so I created the outline. I went through and started creating it. And while I was creating it, we did a pre-sale like any good person that sells these things would do for a 50% discount. So $2,000. And so we sold, I think, 10 just from DMs, no ads, I didn't mention in my podcast, just DMing people that were interested. And once I sold the 10, I was like, okay, I got to create the course. I created this whole course with 9 modules and templates and scripts and PowerPoint. I mean, everything, because I would want people to do this for our deals, right? So I give away everything. And then I woke up in the middle of the night. I was like, this is going to confuse some people. People are going to buy this and think that it's Raise Masters. And if just one person does that, it's going to cost us money. And so I just woke up one day and I refunded all the money and decided to give away for free. And so, by the way, it's a very awkward feeling to go into Stripe and click a $20,000 refund net profit because it's a course that I already created, but you can have it for free. And keep in mind, when I created it, I literally made it with my reputation on the line, thinking we we're going to sell it for $3,000 or $4,000. You just go to fundtofundsmastery.com. Now, full transparency, the reason I gave it away for free is not just the economics of that money, but also because I want you to do this for us. Now you can do it for anybody, but like through the course, I outline, how it is to work with us and how you should find good operators and that. And so, there's some embedded indoctrination in there, but I actually did it with the intention of selling it. So I didn't overdo it. So there you can go. Just grab it there. Fundtofundsmastery.com.
Ruben, can I get one more in? Because I know you're going to open it up to the
real quick before you do that,
ahead.
just want to mention to the audience, we're going to open it up for questions for you guys to start thinking about something that you want to pick Hunter's brain about. Go ahead, Andy.
Yeah, you'll roll your eyes when I ask the process question, Ruben, but I got to know like a day in the life of what, because it seems like for folks that are out there capital raising, they're not all eyes like you, right? They didn't take the disc test. They didn't, they don't love to be the influencer and they don't have to be.
Totally.
But for you, what are those things that you kind of figured out? Hey, I got to just hand it off and maybe just quickly like a day in the life of what you're doing. It sounds like you spend a lot more time creating stuff than actually overseeing stuff.
Yeah. So you mentioned a question about this before. I didn't get to address it. And it's a very important question. So I just did a discussion regarding this topic, which is basically, okay, so just for context, we scaled Raise Masters from 0 to 10 million in revenue in 31 months. And we just blew the roof off of it. And the thing that's crazy about that is I can go and talk about that publicly, and our clients know that and they're proud of it because the client experience didn't feel like that. Like, that's bursting at the seams. Like, I've never blown up a business like that before. That's like eye-watering. Like, think about it. I thought it was gonna be like a 6-figure thing and ended up being an 8-figure thing. Like the challenges, the emotion, the dedication, the speed of, like, I was unprepared for that. So but the clients didn't feel that. And the reason for that is not to do with me, but because I uncovered this amazing thing. After reading Traction, after reading Rockefeller Habits, after reading all the books about business management, I basically threw it all away and uncovered this incredible reality, which is that when you generate enough revenue, you can hire people that are talented beyond your wildest imagination. And all those books are irrelevant. You can read them if you want entertainment. Holy crap. That is the mic drop. Because if you start paying in the 6 figures, especially the multiple 6 figures, the resumes you will see, this guy wants to work for me. It's insane. And so what happens is they've already done the thing you want to do. And so in the interview process, you learn, holy crap, I'm making all these mistakes. In the interview process, it should be like, I'll pay you $1,000 for this level of consulting. Congratulations, you're hired. You're the COO. You now are running ASIM Capital. And congratulations, you're hired. You're the COO. You are running raisingcapital.com. So, like, just for context, my COO is Grant Cardone's former CFO. Like, what? But it's not magic. When you generate revenue, you can attract insane talent. And when you are a rocket ship, you can attract insane talent. Now, some of this, I hear myself talking, it sounds like bragging, but you got to understand that I barely passed English in college, right? Like, I was a struggling C-. I literally remember in economics, by the way, which is like my favorite topic, in microeconomics in college, I remember you had to get a 76 to pass. After all the finals and all the homework I did or didn't do and all the labs I didn't show up to, I got a 76 right on the money. And I remember, like Tommy Boy, going, I am the smartest man alive. I literally did the perfect amount of work to get the exact result I was trying to achieve. That was my attitude through school. So, like, what I'm trying to say is anyone can do what I'm outlining. Like, that's the message. Like, I'm trying to make it clear that this is not some secret sauce. This is the beauty of capitalism. You find out what your strengths are and lean all the way into them and hire talent. If you're starting at a low amount of revenue, you hire a low amount of talent and you just work it up, work it up, work it up. And here's a quick tip right now. And I want to answer your question directly. I know we're going to overtime, but please just this is the most important message, because while raising capital is a lucrative skill, learning how to hire and empower A players blows everything out of the water. Want to know why? Because it's nothing to do with your skills. All of a sudden, your skills are irrelevant. That's why I don't need to read Traction over and over again, because I'm not the operations guy, right? So if you are a solopreneur, that needs to stop today. And when you say, I don't have enough money, absolutely not true, because all you got to do is go to onlinejobs.ph and hire your first assistant for around $300 to $400 a month, full-time, Philippines talent. Total game changer. This is mandatory for anyone listening to this show. You should not be doing silly administrative tasks that you're horrible at, that an incredibly talented A player that costs around 15% of what it would be if they're in the United States, they should be working for you. And not only should they be working for you, I just got a photo of one of our Philippines team members that created a cake for themselves and said, happy 2-year anniversary to Gail. And she's been with us 2 years. And that's not uncommon. We've hired 4 people in the Philippines. 3 of them have been with us for multiple years. So please, if there's nothing else you get out of this, other than going to fundofundsmastery.com, getting a free course, it's insane. Hire someone in the Philippines.
That's awesome, man. Steve Jobs famously said, I don't hire people to tell them what to do. I hire people to tell me what to do. So that's awesome, man.
Yes. So my day consists of doing whatever I want, AKA this interview. Like if you add an extra comma in the bank account, this is exactly what I'm going to do because I love you guys. I have a lot of respect for you and Ruben. I know you've been crushing this game for a long time. And so that's why I'm here.
Awesome, man. Thank you so much
Appreciate
for
that,
coming.
man. We got any questions in the audience? Anything in the chat or anything? Come off mute if you have something that you want to ask Hunter about.
I want to thank Hunter. Thank you so much, actually, on the VC and the site, because I struggle with the VC and this is a good site for me to go to so I can delegate to them. Thank you so much. And everything that you
100%.
said is so powerful and I appreciate it. I have a commercial banking background, so this is very appreciative. And the
I
capital
love that.
raising, yeah, private equity firms. I work with the Wall Street and, but I'm very thankful to you.
Very
Thank you.
good. So yeah, check it out, onlinejobs.ph. And there's a really important
Yes.
piece of this. Let me just give this little tidbit. If you go to that website and you start to create this account, you're going to be faced at this opportunity. We're going to go, I'm just going to go part-time because I don't really know. Don't do it. Total different level of talent, total different level of experience. Trust me, you want to go full-time, you're going to get a committed person and you will fill up their calendar. Even if it takes you 6 months to learn how to fill up their calendar, it is well worth it because your time is worth more than $7 an hour.
I had one, actually, it was more part-time, but now you gave me a tip to get full-time. So thank you
Yes.
very much. Yeah, I need one.
Total
full-time.
shift.
Thank you.
That's mind altering. Okay, cool. We got time for like 1 or 2 more questions. Who's got a question for Hunter Thompson?
Just real quick. Are you guys only working in picking up properties in Phoenix, or would you entertain a large property in, say, the Midwest where the rents are still rising if we bumped into a large distress situation?
Good question. So we have basically said no to everything other than this 40-mile radius around Phoenix, like a real difference in our thesis and strategy, which is why my partner moved there. And basically because we want to be a hyper-focused operator that only knows one thing, right? And so the answer is no. But if you're listening to, like, that's obviously most deals aren't in Phoenix. So we say no to a lot of business. But for the people that want to invest in Phoenix, we just want to be the one that they invest with.
And the fact that you'll ask that question, Rachel, is why I know that you're crushing it. I love it.
Well, we got a 360 and unfortunately the people have this massive bridge and we're best and final. We bid 5 million under asking and we're trying to kind of like pull back and they're like, no, you can go lower. It's fine. We'll take
Okay.
it.
Now I'm gonna have to mute. Now I'm gonna have to mute you. You're gonna have people calling you. All right.
Well, I will
Go ahead,
tell
Ruben.
you, I mean, just real quick. So like, obviously we only raise capital for the deals that we own and control our GPs on just because we've changed the strategy. But as you may know, I run a mastermind filled with capital raisers. And we recently polled the audience. I think it was 120 of them are pure capital raisers that implement the fund to fund strategy. So in our group of 400 something people, 120 are looking for operators to raise capital through that fund to fund structure. So if that's something you're interested in, you can go to raisingcapital.com or raisemasters.com. I'll drop it in there, raisemasters.com, and check it out. And if it's a good fit, you can book a call with my team and we can find out. Now, I'm not promising you that someone's going to raise money for your deal, but like I have seen literally tens of millions of dollars of equity trade hands with the members that we have.
Can you talk a little bit about selecting an operator? Like, because if you have this many people that you could potentially partner with, like if they're saying no to you, it's because XYZ about the people that you want to do business with. So for the optimal success rate, like who do these fund managers want to partner with? And if you're a capital raiser, like what do you want to select in another partner before you do business with them?
So the one thing I'll say is that you don't want this to be a scalable enterprise. You don't need like 30 operators. You probably need like 5. And in the same way, that's how many best friends you probably have, right? You can probably think of somewhere between 1 and 5 really close friends that you would go to bat for, lend money to. That was kind of my strategy. And so starting with that is good. So basically inbound request is just, that's not going to get anywhere. Hey, you need money. Like, so does everyone. Like, that's not it. But if you want to simulate some of those relationships and expedite the timeline, I would definitely think about going to some in-person events and starting to network in person, whether it's a retreat or a conference. You start to get the vibe of people, which is way more important than the underwriting or the thesis. And then another really important thing is to visit them on site once you've done a couple of due diligence calls with them. Being with them, you kind of get the white space of what they're actually like, because what really matters is not the underwriting model, not the thesis, not because Phoenix is the #1 country, growth country. That is all freaking irrelevant. What really matters is, what are they going to do when things go wrong, and what can they do when things go wrong? Meaning, do they have the integrity and do they have the balance sheet? Because the integrity without the balance sheet, you might as well have neither, right? Because this is what we're finding right now. If you are, oh, I would do anything for my investors, unfortunately, I have no money. Well, you will do nothing then. Right? So those are the things that I'm thinking about. And then, of course, we'll go into the details. Let's talk about the Excel. Let's talk about, oh, is there softening in Phoenix? Is there going to be foreclosures? But that is all secondary to what are you going to do when things go wrong, which they will every single deal. Anyone on here knows that no deal that they've ever done in real estate's actually gone to pro forma, right? It's been above or below. What really matters is how they navigate the in-between.
Is there anything, Hunter, in your book, if you're to think about it now, that you cringe at reading or that you wish you could take out?
That's so funny. So, I did put a lot of disclosures in there about the legal stuff, and I did have an attorney review everything. In fact, multiple. But there's I'm not going to go too far down this rabbit hole, but I'm just answering your question honestly.
Yeah, no, I didn't even expect you to have an answer. I'm just curious if you.
There's just one thing.
I talked to a lot of authors, and they're usually something that they wish they did differently.
It's not the kind of thing you normally hear of, but I'll clue you into the nuances of this. So when you create a fund of funds, you are no longer doing what most real estate investors do, which is investing in real estate. Usually you buy real estate directly. When you create a fund of funds, you're actually investing in securities. And so what's interesting about this is that almost every attorney even if they have a $1,500 an hour rate, if they're a real estate attorney, they're not specialists in a different branch of law, which is the 40s Acts, which is focused on the Investment Company Act of 1940 and the Investment Advisor Act of 1940. You probably, most of you real estate entrepreneurs out there probably haven't heard of those acts, or those don't come up frequently. Usually you're focused on Reg D, 506B and 506C. Am I right? So when I would go to attorneys and ask them for advice, they unknowingly would be giving me advice about a matter that is not directly related to this particular nuanced topic. Now, I didn't say anything in my book that was wrong, but I definitely would have described it slightly differently, because the reality is, it's like quantum mechanics, securities law. Like, you start getting into the details, you uncover that, holy crap, like the rules don't apply. Like A is equal to not A. Like this is the nature of law, because every attorney disagrees. Does that make sense? I think that metaphor is super applicable. You zoom in close enough and you go, holy crap, no one knows what's going on. And then you realize that's all intentional. They want to have the market be gray so that they can basically pursue anyone that makes a bad error. So you try to stay away from that. You try to keep investor capital, because the laws, when you zoom in super far, are super nuanced. So now, and I'll do it right now, in all my trainings, especially when I talk about this particular topic, I show a picture of the fact that I wore Jinko jeans when I was in high school. And I have a disclaimer that says, please know that I used to dress like this. I am a victim of fads. I am an idiot. I got a 76 in microeconomics. Don't take what I say seriously when it comes to this legal stuff, and contact an attorney that's a specialist in this very topic. And I say, listen, if this ends up showing up in court, they're not going to pursue me, because I look freaking ridiculous here.
That's amazing.
And by the way, if you don't know what Jinko jeans are, Google it.
Yeah.
Okay, cool. What about any promotions or anything that you want to mention? Obviously, there's this incredible book, Raising Capital for Real Estate. You mentioned the fundofundsmastery.com. And I think you have an event here in my hometown coming up in February of next year. Anything you want to mention about that?
Yeah. So basically, we have the coolest conference ever. I think I can make that claim. Best ever real estate conference. I'll say it. They're the best ever. But if I want to say coolest ever, we're going RaiseFest. So all you got to do is go to raisefest.com. We do a cool version of mixing fun, electronic music, and capital raising stuff. It's just a total blast. I don't know, Ruben, if you were there last year, but it's going to be in Phoenix this year, and there's going to be 1,000 capital raisers there. And the beauty of this, especially given that we talk so much about pure capital raising and fund to funds is that when you go, you will be surrounded by people capable of raising millions of dollars. Many of them will be interested in raising money for other people's deals. So it's a total no-brainer. February 22nd through the 24th in one of the most highly transacted markets in the country.
Hey, so I saw you doing a promotion about RaiseFest, and you mentioned, hey, if you buy now, you get a free VIP upgrade, some other things. But like, what about us people that like bought the ticket like 8 months ago? Like, can we get a free upgrade? What can you offer us?
No, now you're dogging
Ask him
me
to take a
out because
marketing class.
you're dogging me out because so that sale ended, but you got a price that was way below. So you're going to have to pay for your upgrade. You'll pay for your upgrade, but you're still not going to pay as much as the people that just bought the ticket. Because
Ruben is famous for calling all the cable companies too. He's always like, hey, look, DirecTV, I just saw this thing that happened 8 months ago. You gave me the
I don't know what you're
NFL
talking
network.
about.
Well, no, there's a lesson here. Can we talk real quick? I know we have 4 minutes, but please, there's a lesson here. So for Ruben, we created like a 48-hour sale for people that had just gone to RaiseFest. It was like a ridiculous price that you'll never see again. And so, yes, you'll have to pay extra to get the VIP upgrade, but still, you'll still pay way less than anybody else. And here's why. To your point, Andy, we will always reward action takers, meaning that we will never penalize someone for buying a ticket earlier. And the same is true for your deals. Let's say you have an open-ended fund. I would really suggest creating a class of shares that only exists and is more favorable, let's say higher preferred return, more favorable waterfall for the first 2 months or something like that to incentivize people to get the money across the finish line. By the way, anytime we add an additional bonus after the fact, we will definitely give anyone that bought a ticket before access to those bonuses. That's a really important business practice, and I just wanted to highlight that.
Awesome.
Great
This has
stuff,
been a
man.
blast. Andy, any last words of wisdom or anything that you want to mention before we sign off here?
No, I just wanted to have everybody kind of take a look. This is kind of the guy for capital raising today. Like when I first started picking up the phone, before the, 2008, 2009, 2010, before the Jobs Act, is trying to get money. There's just so much wisdom in what Hunter teaches. So I just encourage everybody to take a look, take a deeper dive into the stuff that he's doing. And
Cool,
I love
Hunter.
this community. Love you, Ruben. Thanks, man.
Yeah, love you too, dude. And man, this has been a blast, Hunter. I look forward to hanging out with you and getting another selfie up in Phoenix here in my town. And maybe we can look at some exploration of doing some additional collaborations in the future on marketing funds or who knows, like maybe get you back on the Capital Raiser show and do a one-on-one interview. I still have yet to take you through the lightning round, if I recall correctly.
Oh,
wow. Okay. No, I know why that is, because I pushed the show so late that you're like, all right, we just got to close up and now we can't do it. So it's going to be forever going. But the reason I'm just trying to add value. I love this group. Thank you so much for the opportunity, man. Let's do it again. I'll see you in Phoenix.
Cool, brother. All right. With that, we're going to sign off. Take care, guys. Appreciate you.
Legacy Acquisitions